This video is to accompany the notes on Chapter 13, Current, Contingent, and Estimated Liabilities for the Intermediate Accounting 2 class. We begin with more or less a definition of liabilities. A liability is a present obligation arising from a past transaction, which entails a probable future sacrifice of economic benefit or provision of future service. You may see how this definition parallels the definition for asset that we have seen earlier. The main distinction, of course, within liabilities are between current and non-current liabilities. Now, as a working definition of a current liability, it makes sense just to describe it as an obligation that comes due within 1 year or one operating cycle, whichever is longer. That more or less parallels the definition of current assets. However, the technical definition is a bit more involved than that. A current liability is an obligation that's expected to be satisfied by the use of current assets or the creation of new current liabilities. This includes the current portion of long-term liabilities. And this opens the possibility, or leaves open the possibility, that if we have an obligation expected to be satisfied by the use of long-term assets or the creation of long-term liabilities, or I could add to that actually say stockholders' equity, then in fact what may otherwise be a current liability would qualify as a long-term or non-current liability. We'll see, talk more about that, of course, in most of these things later on. Liabilities are recorded at the present value of expected future cash flows. In other words, that's technically the way that we determine the value, the recorded value of liabilities. In practice, though, current liabilities are reported at the full maturity amounts, or net realizable value. What this means is that if you've got, say, a liability that comes due in 60 days, technically we would need to solve for the present value of that liability as of today, and that would be the amount recorded for that. APB number 21, though, specifically excludes short-term payables from the present value reporting requirement. Now, throughout the rest of your notes, we cover various types of current liabilities before we get into contingent and estimated liabilities. We start off here with by far the most common instance or type of accounts of current liabilities are accounts payable. They are sort of a catch-all category of liabilities created when goods and services are bought over time. There are two basic ways to account for for accounts payable and the purchases related to that give rise to accounts payable. And so we're going to look at an example here and apply the gross and the net methods. For this example, we've got $100 of merchandise that we're purchasing, and on terms of 210 net 30. Hopefully you'll recall that means that if you pay within 10 days of the invoice date, you can deduct 2% from your bill. Generally, it doesn't include any shipping cost if there's an explicit cost there, but 2% discount if you pay within 10 days. Otherwise, the gross amount or the total amount is due in 30 days. Now, what I'm going to do here, I asked the question what inventory control system is assumed, but let's look at the entries to start, and then I'll come back to that question. Notice in this case we're buying inventory. Under the gross method, we're debiting purchases, crediting accounts payable for $100. That is the gross amount of the purchase. Under the net method, though, we're recording that purchase net of the discount. And so we record the purchase and set up the liability for $98, the $100 minus the $2 representing the 2% discount on that. Now we also need to see how we would record payment. So if payment is made within the discount period, and here because there is a discount, by the way, we've got two possibilities. You pay within the discount or you pay beyond the discount period. Notice here, if we pay within the discount period, then on the gross side, we debit the accounts payable for the full amount that was recorded, $100, but we only have to pay cash, that is the asset we sacrifice, and cash is only $98, and so we record a purchases discount or purchase discount. Under the net method, notice we recorded that purchase at net, and we simply have to debit accounts payable for $98 and credit cash, so it looks a little bit cleaner over there. We might say that in the case of the net method that we are anticipating, we know we're going to pay within the discount period, and so it's a little bit easier or cleaner transaction. On the gross side, we're capturing, in one sense, the benefit of the purchase's discount. We know how much we have saved here by paying within the discount period. Now, by the way, going back to the original question, what inventory control system is used, the answer is we're using the periodic inventory system. Were we using a perpetual inventory system, we would be debiting inventory wherever we've got purchases here. By the way, down below, when we make the payment under the gross method, when we record the payment itself, since we're not really paying the full $100, we have recorded that purchase at $100. We're going to credit inventory for that purchase's discount to reduce inventory back to the actual price that we paid for it. Well, we have to consider another option, and that is that we pay beyond the discount period. And so in this case, as you can see, if we pay beyond the discount period, then the cleaner entry is under the gross method. We simply debit accounts payable for $100. We credit cash for $100. Under the net method, we more or less made this original entry, the purchase, anticipating that we were going to pay within the discount period, and we didn't. Notice here what we would do is we would debit interest expense for that $2. Notice we can't debit accounts payable for $100 in this case because that's not the bill that we have on the books. That's not the liability we have recorded. So we have to debit interest expense. In one sense, what we're saying here is that if we fail to pay within the discount period, then it's because we have more or less chosen to finance that purchase for what really represents an additional 20 days. You know, if you think about it, if you get a discount for paying within 10 days and then you miss that discount period, you're really only buying an additional 20 days. So notice it's treated as a finance cost here, a financing cost. Now, what's the nature of the purchases account? Well, remember, purchases represents an expense account. And so under the periodic system, we are debiting purchases an expense account when we buy inventory. Under the perpetual system, we're debiting inventory, an asset account. Hopefully you'll remember it all works out fine through the adjusting entries and closing entries at the end of the period. But notice here, if in fact purchases represents an expense account, then purchases discount represents a contra expense account. You might even find a purchases discount lost account under the net method. If, for instance, you've anticipated that you're going to pay within the discount period and you don't do that, if you lose that discount. But that's really what purpose the interest expense serves here. If you had a purchases discounts lost account here, it more or less would be an additional expense account to supplement more or less the purchases account. In that sense, it would be what we have called an ancillary account. Current notes payable. Major issue when we deal with notes payable is to properly report the interest expense in the appropriate period. We will value notes payable at the net present value of the obligation itself, which is consistent reporting with its counterpart, notes receivable, under the assets. Well, let's look at an example here. On October 1st, ABC Company borrowed $10,000 on a one-year note bearing interest of 10%. And so we're going to record this note. Notice here we're the debtor here, so we're receiving cash of $10,000 and crediting notes payable, creating that liability. Well, let's imagine that December 31, the calendar year, is the calendar year end and the fiscal year end. And so because we originated this loan on October 1st, we need to accrue interest as of that date. Well, you'll remember that interest for any given period is calculated as principal times rate times time. Principal, the $10,000, 10% the annual rate, and we have to accrue interest for 3/12 of the year, October, November, and December. And so that interest is $250, so as of December 31st, we will need to accrue $250 interest through this entry. We might also see an account, instead of interest payable, accrued interest expense. So, be aware of these other possible versions of the name for that liability. Accrued interest expense and interest payable are really the same thing. What entry is required when the note then is repaid on October 1st of the following year? We have to remember, of course, that we have accrued interest as of year end. Well, here it is. Notice we've got to debit notes payable for $10,000. Notice that we had an interest payable amount set up already as of year end related to this note, so we have to eliminate that through the debit of $250. And of course the interest expense, that is for the period from January 1 to October 1st. That is that 9 months will interest, and you can figure that, of course, by 10,000 times 10% times 9/12. Those other 3 months in that 1 year note. Total interest, by the way, is $1,000, and so the amount that we have to repay is $11,000. We might also have non-interest bearing notes. That is, they're notes where there is no stated interest rate, usually set up such that interest is deducted in advance. That is, it's a discounted instrument. The borrower receives only the net proceeds. These may be recorded at the gross amount or the net amount. Here's an example. Bilco Inc. purchased a machine for, we're going to figure that out in just a minute. They paid $2,000 down. They issued a non-interest bearing note.